Everyone, I'm Dharmendra here. Again, we are here to, you know, uh, talk about important topic of how to, maximize growth through M&A in the current economic environment. Today, a guest is none other than Sam Panda, who is Managing Director and Partner for Accenture. And we are going to have some very interesting discussion today. So, just hold on for a second and I will introduce Sam. So Sam, if you can just give some about your M&A practice within Accenture, tell something about your profile, what type of deal you do, that will be good for our audience.
Yeah, absolutely. First of all, Dharmendra, thank you for having me on this podcast. Really excited about our conversation today. So quick introduction, Sam Panda, I'm a managing director in Accenture Strategies global M&A practice. I specifically focus on both private equity and high-tech industry deals in North America. I'm a Chicago-based MD. Accenture strategy has a very large M&A practice. It's one of the best kept secrets in the firm. We have 6 global M&A hubs across the world, dedicated professionals of about 1,300 people that just do deals. So very robust global practice that follows one methodology. The interesting thing about Accenture is we are the most acquisitive publicly traded company. We've done about 120 odd deals in the last year and a half. And the methodology that we kind of bring to market is the exact same methodology that we use internally for transactions. So it's not only time tested with our clients, but it's time tested, internally on our transactions as well. There was a statistic that Accenture does almost a deal a week, right? And these are technology deals. So as you can imagine, there's a good intersection and synergy between what we do as a company for ourselves and what I do in the market with my clients. I have been with Accenture for about 4.5 years. I'm a career consultant. Prior to this, I was at Deloitte, and before that, I was at PwC, all in the US, and all focused on M&A, both pre-deal due diligence all the way through post-merger integration and divestitures.
Yeah. So thanks for giving this, detailed, profile of you and Accenture, because we know that Accenture have a global hub of M&A professionals around the world, and we have 6 hubs. But really, I was not sure that, doing a deal every week is like, really, it means a lot. So, I think our audience today will surely like to get more insights as we go on. So couple of pointers which I have in my mind, which I think I collected through our audience, that what type of question I should have. So first question, to you is, so if you look at most of, M&A is one of the lever for, any company for growth, right? Now, just after COVID, there was a, big start, and then slowly it has come down. So activity is a little slower. I know it's a strong, opportunity in the market, but then in your opinion, how has this M&A activity have been affected by current economic and geopolitical environment, including the post impact of COVID-19?
Yeah, that's a great question. So look, we also saw a global spike in M&A activity during the pandemic, right? And that was primarily driven by companies that wanted to invest in a long-term advantage. Trends like digital was forefront of everybody, so they made a bunch of acquisitions. 2022 saw a reversion of that trend, right? We went back to a more nominal deal level that kind of was akin to pre-pandemic levels. 2023 has been even more challenging. Think about inflation, high cost of capital. I was just looking at the statistic. The Fed fund rates in the US was 0.08% in Jan 2022. It's close to 5% now, right? So it's the cost of capital has just gone up exponentially in the last year or so. Add to that geopolitical tensions with the Ukraine crisis, a looming recession, perception of like the banking crisis that we're seeing with Credit Suisse and Silicon Valley Bank. These are all new risk factors, right? But what that's resulted in is both corporate and private equity acquirers are becoming more conservative. They're taking a relatively, they're kind of betting on like smaller deals, and that's translating into a lower number of large deals, right? That said, we're seeing upsides. I mean, think about it, like valuations are down from historic highs. We've looked at both price to sales and EV to EBITDA multiples, both for global and US deals, and they've come down significantly. Like, just to give you a sense, for US deals, typically P2S ratios were about 8x, right? That's come down to 5x. EV to EBITDA multiples used to be 28x. That's come down to 23x. So they're coming down, right? So that trend is making you find more value in potential assets. Second thing is that, look, historically, downturn deals have outperformed. We've looked at total shareholder return of downturn deals, and they're about 10% higher than what strong economy deals, right? And that's a critical kind of upside. You look at the amount of assets that companies have, like companies are sitting on about $12 trillion of cash on the balance sheet, right? Or cash equivalent, which is up 60 or 70% since 2017. Over the same period of time, private equity firms are sitting with $2 trillion of cash. So there's a lot of kind of positives there. And then you kind of close it out and think about, companies are looking at trends like, to be future ready, trends like AI, ESG, digital, industry convergence, right? So there are things that will obviously help. So there are some tailwinds, but at a macro level, I feel like, things are becoming more, I wouldn't say slowing down, I'd say more reasonable and more manageable. And companies are looking for specific gems that they can then take and kind of expand and grow.
Yeah. So, so I think this is very good input for, so good that, M&A is still outlook, if you look at it's more positive. And even this current economic environment due to, current issue with the, Silicon Valley Bank and other issues we have, still, I think M&A, outlook is better. And I think future should be better than what we have today. So my next question is primarily when if you could just highlight some of the risk what company must consider when evaluating M&A activity today. So either it's a small firms, like you said, private equity guys are buying company, maybe a smaller in size. So what is the typical, any risk if you see that company must consider?
Yeah, so look, there are risks, the traditional risks that we've seen, right? IP, quality of earnings, etc., that you normally kind of look at. I think if you think at the last 12 months, there are two new risks that have come to the forefront. One is the uncertain regulatory environment, and this is massive, right? Like, I'll give you an example. Like in the US, the Biden administration, they signed an executive order in 2021 that basically allows both the FTC and the DOJ to challenge mergers that were previously approved. So just think about it from a planning perspective. You're a deals guy, right? It's harder to plan when you think that something's approved, but then somebody's going to go back and challenge it, right? Right. Similarly, in the UK, the Competition and Market Authority is also being extremely, challenging in terms of the type of deals that they approve. Like, look at the Broadcom VMware deal, right? They announced that last year. That's still kind of slow moving, given the UK regulators are looking to challenge this deal. Yeah. So that's kind of one element, right? That uncertainty in the regulatory environment. The second thing is around data and consumer privacy laws. We're seeing this global trend, again, in the US, like just last year alone, there were 59 bills across 29 states that were considered, right, by the legislatures just around data privacy. You add, and that, by the way, that number has gone up to about 20-ish, which was the year before, right, in 2021. So that's becoming a macro trend. Then you're seeing enhanced data privacy regulations in some of the states come into effect. You add that internationally with like China and India taking a stance on data privacy, trying to protect, their customer data in their geos. So that's becoming a more of an additional hurdle that companies need to kind of look into. Now, that said, there are levels that you can do. You basically have to do, a more, scrutiny during due diligence, right? You have to plan better, get upfront planning, leveraging a clean room even more outside of the traditional things that you would do in a clean room, to do that upfront and basically start planning in a protected environment. That becomes important. I also think that there's going to be a trend where companies are going to look at other deal constructs from an outright acquisition, potentially partnerships and JVs, just to work around this uncertain regulatory environment and data privacy laws that we're seeing.
Yeah. So I think I was about to ask this, how can this risk be mitigated to achieve maximum outcome of the deal? So I think you mentioned 2 points. So any other point to be considered to mitigate any risk for the maximum outcome of the deal?
Yeah, the only other thing I would add, Dharmendra, is like there's a trend, right? Like people they move to both ends of the spectrum, right? So
Right.
when things get challenging, they stop doing what they would normally do. I would caution against that. I think, bringing in integration planning, getting that started as quickly as possible, as early on in the deal life cycle, is still an important thing to do. It's just that how you do it changes a little bit, right? You might have to be a little bit more protected. You might have to ring fence your integration planning teams. But I think it's still really, really important to be able to plan during that longer sign to close window versus waiting for the deal to close and then kicking off planning, because that will have an impact on the business case for the deal, right? And when you're working in an environment where still multiples are near historic high, you don't want to be wasting time. You don't want to lose out on potential value pools. You want to be very cognizant of your business case and make sure that you're executing in a thoughtful, deliberate manner.
Right. So I think we have to be cautious than,
Yes, absolutely.
Yeah. Okay. So I think my next question is just related to this, but, slightly I wanted to get your view of, so if you can just give some of the key strategic consideration that company need to keep in mind while they are aiming for, growing through M&A in present scenario. So what should be some of the strategic consideration company have to think?
Great, another good question, right? So I think there are a couple of things that companies need to look at. First of all, they need to have real clarity on answering the question of where do they want to play, right? They have to look at acquisitions as not only a way to get ahead of the competition, but also this notion of future-proofing their business, right? It kind of goes back to the trend that I was talking about of transformative deals, right? Industry convergence, AI, digital, right? They're going to be fundamentally core to any business. And therefore, companies need to start looking at M&A, but how does that tie back to their overall corporate strategy? I think the second thing is, they need to have a clear view and anchor all of their planning efforts around delivering deal value. What does that mean is, like, for early stage acquisitions, right? They need to focus on the ability to scale those acquisitions. How do they integrate IP into their existing product set, right? Versus for established assets, they should have a clear view on both cost and revenue synergies. And look, at the end of the day, in this environment, they have to be agile, right? They have to be prepared for any sort of eventuality, whether that means, divestitures to get over regulatory hurdles, right? Or that means, bringing forward the integration planning effort so that even though they've got more time, the sign to close phase, they're not stopping planning, right? They're continuing to be thoughtful and deliberate about planning.
Sure. Yeah, I think these are very important. So, if you look at changes in regulation can have very significant impact on the ability of company to pursue any M&A activity. So how important it is, to keep up to date with regulatory changes for successful M&A? Maybe you could have come across such, regulation hurdles.
Yeah, I know we talked about this a little bit. I mean, it's really important, right? Both in terms of how regulators are operating nowadays. A lot of these deals are also managing public perception. So you have to kind of, figure out how do you kind of, keep your finger on the pulse of what the market's thinking, what the general public is thinking, and how does that influence the way regulators think. The second thing is, it's important to try and look around the corner a little bit to see what regulations are coming in. Like we talked about data privacy laws, right? And what type of impact they would have on the type of transaction that you would do. So very important to get a sense of both current and future regulations, and how does that influence or change your the type of deals that you do and how you do the deal, right? From an integration perspective, it is super important. Get your your legal team involved early. And then for in tech companies like the industry that I operate in, there's obviously the traditional stuff around IP protection, the technology disruption, right? Your ability to kind of thwart competition in areas where the regulatory enforcement mechanism is slightly weak. Example, China, right? How do you kind of operate in that type of an environment? It becomes super, super important.
Right. So I think so. This is one of the criteria for making sure that whenever we are going for next M&A deal, we check the regulatory changes, what is now and what is going to come, right?
Yeah.
Something which is announced. Okay, thanks. So my last question, but this is kind of summary of it all, whatever we have spoken. So if you can share some of the key action point that organization can follow that will help in good growth through M&A activity in the current economic scenario. So this question is primarily for our audience who can take this as a guideline and some of the key points that they can apply to their deals when they are going through.
Yeah, look, macro level in today's environment, having strategic, financial, and execution discipline and focus are critical to unlocking not only strong but sustainable value from deals, right? From my vantage point, I think there are 4 key things companies need to be doing in order to be get maximized deal value. The first thing is they should have an alignment on the strategic vision, the current state of the business, and the available resources, right? Let me elaborate a little bit about that. We talked about this notion about answering the question where to play, right? So that means that it's not only just defining the what, but it's also stacking hands across your management team and the board so that they buy into that strategic vision and potential.
Right.
You should also have a clear understanding of which parts of your business are adding value and which parts of your business are subtracting value. And that's really important because, in order to get through regulatory scrutiny, right? Like there's this notion, public perception that companies are becoming too large, playing across multiple spectrum, and they'll typically see challenges, right? So one way to get around that is divestitures and kind of becoming more lean, nimble, focusing on the future of the business while maintaining your core. So we think that's really important to continuously evaluate different parts of your business and see how does that tie back to your strategic roadmap. And then the other thing on that first point I would say is evaluating your assets, right? Look at how much cash you have in hand. What is your borrowing capacity? For public traded companies, cash plus stock deals is better to do than raising money, because like we talked about, cost of capital is really high. The second thing I would say is, they should constantly identify and prioritize potential assets, right? Very important for companies to have a good grasp on capabilities, technologies, market access, scale, and other factors that are needed to achieve growth, right? They need to look at, segment potential as an example, right? Across priorities so that they know, again, tying back to their vision, that they know by those areas, right, where they want to play, they have specific set of targets for those areas. So for example, if you're looking into AI, have a good sense of what are those companies that are at the forefront of AI. They might not be large companies, they might be smaller companies, but maintain that list and constantly evaluate and keep updating that list. They have to prepare their organization. That would be the third point, right? And move rapidly. Again, uncertainty around regulations, all of the economic headwinds that we talked about, geopolitical tensions. So you have to plan better. And planning cannot be done by corp dev anymore. You have to get more people involved. You have to make sure that there are robust planning, both at the functional level, at the cross-functional level in terms of like operating model, etc. Like those things are really, really critical to do. And then the last thing I would say is you need to be ready for divestitures, right? You're hearing there's a growing trend. Like look at like what GE is doing in terms of spinning off their into 3 companies, right? Conglomerates are going to be getting smaller, and they're
Yeah.
going to be divesting non-core assets. You know, we talked about Schneider, right, where you work, but think about a competitor, Emerson, right?
Yeah.
How many
Yeah.
divestitures they're doing, but they're still very acquisitive. So their
Yeah.
acquisition is not stopping. They're just constantly looking to rebalance their portfolio. I think that would be the last kind of thing that companies need to be aware of as they look to unlock and maximize deal value.
Right. So thank you for very insightful discussion today. I know we wanted to keep it lit short, but I think the topic is so interesting. So what we'll do, Sam, we'll come back again to you, and we'll go to some specific topic, and that will be, we get lots of feedback from our audience about the topic they would like to know. So we'll come back to you with the next set of podcast with you. Thanks for your time, and thanks everyone who is listening this. Thank you.
Yeah, thanks, Dharmendra, and I really appreciate the conversation. Like I said, 30 minutes is sometimes too short. 25 minutes is shorter, but this is a topic that both of us are passionate about, and we could spend literally a day just talking about it. So appreciate the time, and thanks for having me.
Thanks once again. Thank you.